Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I haven't had him on for a while, but he is a very good contrarian investor. Him and I both love Sir John Templeton. Sir John Templeton is both of our favorite investors. So we've studied the way Sir John Templeton, looking for the point of maximum pessimism, looking for contrarian value investing ideas in different markets, sectors, countries. He is the author of Bear Market Rising, and he's also a former hedge fund manager. He used to do a paid newsletter, Addicted to Profits. I don't think he's doing it right now. He may be relaunching in the near future. Dave Skarica, thank you for joining me again.
Yeah, I'm actually relaunching it by the end of June. So I decided to do it. I took a few years off. Like, it just became too easy to make money in the markets. Oh, and Jason, thanks for having me on. Do the pleasantries here. But so then I started doing some other things. I started doing consulting, blah, blah, blah. But now I'm like, I've done very well trading options, especially put options, obviously, in the last 6 months during this market decline. So I'm like, I think now it's where people want their money more actively traded. You have to be a little more nimble. You actually have to know what you're doing. The problem that this massive bubble we've had since 2009, especially since 2020, and the COVID kind of crash that happened that March of that year, is it's so easy to make money and no one wants to listen to anyone. And the people that knew nothing about history or markets were the ones making the most money. But now you have to actually kind of know what you're doing,
And we're recording this interview on Thursday, June 23rd, 2023. You talked about trading stock options, having success the last few years. I mean, there's been enormous amounts of volatility the last 6 to 8 months, really since November. I thought at any point since November, I was starting to get worried about a stock market crash back in November, that we could crash at any point, that we were weeks away from that and things were teetering. So when that is the case, normally you're going to have a lot more volatility. The VIX is going to spike. Smart investors are going to start selling their more profitable stock investing positions. They're worried about margin calls. More people are going to cash.
Yeah, well, like, I do believe a lot in the seasonality of trading. So, and I've done the same thing as you. Like, it was really, to me, it was more like, you're talking about my book, Bear Market Rising. I actually wrote that way back in 2015 because I was worried about the market then. I thought the Fed was going to start raising interest rates. And we did have a good sized correction in 2015, 2016. And then the market started up up again after Trump got elected. And then in 2018 had a nice size correction, kind of a borderline bear market. And then, of course, 2020, everything kind of smashed. But we've kept going up and up, mostly due to loose monetary policy. But one thing with bear markets is once you get into November, December, now markets have historically have peaked up out in that level. Like, it peaked out in like November of 1980. I'm not going to go into all the history, but if you go look at the history of it, you'll see a lot of peaks have happened between November and January, but not many crashes or whatever. Because I think once you're kind of into that, like that time frame, it's like, the managers are going to get their fees. People are kind of complacent. They're not going to sell if they're up by November because, they rather defer their taxes to the next year, or say start selling in January or February. So seasonally that wasn't going to happen, but definitely like last year I started getting worried again. So like I said, I wrote this book in 2015, 2016, like in about 2019, I didn't have a lot of shorts. In 2020, after COVID, I did not have a lot of shorts other than just like a couple hedges. But I would say in the middle of, in spring and summer 2021, I started putting them on, and I was on most of the stuff like ARK, Buzz, which is another ETF, stuff that was the high momentum stuff, which actually peaked out ahead of the market. And then late last year, I really started getting heavily short. Like I was really turning bearish on, say, like Nvidia, which I know is a momentum favorite for a lot of people, but it was purely technical. It was just Nvidia, in my opinion, was like in a total parabolic blow off. It's like a classic, some people call it a skyscraper chart, where you're up and then you're down. If you look at what a skyscraper looks like, from the ground. And that's when I really started getting worried. And even though I'm a gold bug and I'm and people consider me a commodities guy, I wasn't that bullish on a lot of the commodity stocks for the first 6 months of this year. Even though commodities have gone up, the juniors and a lot of commodity equities have not been that good outside of oil and gas. And part of the reason is liquidity. I was just like, if we're going to see rates go higher, stock prices go lower, it's not going to be a good for a lot of the commodity trade. So I've been mainly focused on shorts. No, I think we're getting to the point where some sectors are getting cheap. We're getting to kind of this quiet season, right before the holidays in early July. So I think the next few weeks or month or so, I'm not as aggressively short, but I think definitely, after say July 4th, I'll be looking to re-enter some positions. And from now to the fall, I think we could see another leg lower. I don't believe the Fed is going to pivot until we see commodities break harder, the stock market break harder, prices and inflation break harder. One of the best indicators of where the Fed funds rate is going to go, for example, is the 2-year Treasury. If you look at the 2-year Treasury going back to 40, 50 years, that wherever the 2-year Treasury peaks out at, rates go usually within a quarter to a half a point of that. This time it was 340. So that tells me that the Fed funds rate is probably going to go to about 3%. And by the way, this is what's really interesting about 2-year Treasury. This is the first time in over 40 years we have seen a higher high on it. So if you go look at it, it's been trending lower ever since 1980 into 2020, 2021, and all the cyclical highs hit about 7% in 2000, about 5% in 2007, about 2.5% in 2007, but now hit 3%. So I think this means that the secular bull market in bonds is over. Now, that doesn't mean that yields are going to 10% overnight, as we were discussing off air, because all these governments, including the US government, they all be broke. But I do think that slowly, that means yields are going to be going higher in this kind of era of higher inflation. Now, if they do raise rates to say 3% on the short end, I think they'll eventually cut them. I don't think they'll be able to cut them back to zero, but they can cut them again, try to bail out the markets. But we're going to see these kind of this higher highs in yields slowly progress. And the question is this with yields, this is a longer term question, is are they going to just let currencies collapse to keep yields low so governments don't go bankrupt? Or does the market kind of start dictating it, right? Does the market say, no, there's too much debt out there, you got to raise rates to crush it, you got to start cutting government spending, etc. So that's what we don't know. Because in places like Japan, it looks like Japan is going to try to keep yields as low as possible and say the hell with the currency. But in places like Argentina or Venezuela, these other countries, yields spike and basically force austerity and force governments to almost go bankrupt. So the question is, which one of these is going to kind of happen, right? So but that's a very long-term question. But for now, in the short term, I think what makes this bear market different from even 2000, 2007, 2020 is in all of those bear markets, at some point, the Fed was able to start loosening monetary policy, during the bear market. No one, you remember they cut rates the whole way down, 07, 08. Now they're raising. Not only they're raising at the fastest pace in more than 40 years. So at a time when equities are vastly overvalued. So I think that's something that a lot of investors are kind of ignoring. But we're kind of in this early stage of the downturn where it's similar to say 2007 or 2000, where the economy still. I know the economy looks like it's probably going to start going into recession soon, but unemployment is low. The economy isn't falling apart. So I think that breeds a lot of complacency. And then I think after a while, you get the panic when the actual economy itself starts to break down, and that feeds into stock prices as well.
So normal seasonality for this time of year here in the United States in the summer for U.S. markets, for listeners who are not familiar, maybe if you're not familiar with markets or you're not American, is sell in May and go away, come back after Labor Day. However, we're starting to have a very painful bear market. We've had some bear market rallies. It doesn't look, at least to me, and Dave, you could talk about this, it doesn't look like the bear market is over yet. I don't really see any signs. I think the market is worried about additional Fed rate hikes. I think the market is worried about inflation in the real economy. The market's definitely worried about energy prices. Energy prices are still very high. Those are going to cause a lot higher costs throughout the global supply chain. So until some of those issues are solved, I don't think the bear market is going to go away.
Yeah. And I think like when I look at these past bear markets, because people put up these charts and they'll compare it to 2008 or 2000, but no bear market's ever going to be exactly the same. Actually, the bear market though, yeah, maybe I'm contradicting myself, but I think it's most comparable to, especially on the S&P, is actually the Nikkei in 1990, right? And in the Nikkei in 1990, it peaked right at the end of the year, just like this peaked right at the end of 2021. And the first leg down was about 30% before the first really significant bear market rally. And I mean, one that lasts months, et cetera. And then it kept grinding lower until actually the fall of 1990. The Nikkei was down about 45 to 50% from its highs. And what's interesting about the Nikkei in 1990 as well is the Japanese central bank was raising interest rates all that year. So I think that's kind of interesting because the monetary backdrop is similar to 1990 in Japan. So yeah, I'm looking at like basically like maybe the S&P gets back to the pre-COVID highs, like, 32, 3,400, before a significant bounce happens. Like, I know we bounced this week a few percent on kind of light volume. So like I said, I can see that happening, but I think we won't see that really good bear market type rally until we get to those levels. And people don't realize how overvalued this market was. Like, and I'm not even talking about stupid crap like, like
altcoins,
yeah, or digital apes, like, like it's just like
crypto witch NFTs where like the women are wearing lingerie, and like a lot of women in tech that were making 6 or 7 figures were talking about all these crypto witch NFTs wearing like no clothes that they were buying.
It's ridiculous. Like I was telling you off air, like this girl I know who's a model in Spain started like an NFT thing on Twitter. And I've been doing this for 20 plus years, and I have I think I have 18 or 1900 followers, almost 2,000 followers on Twitter. And she got 40,000 like in 6 months because she was a hot girl, talking about NFTs.
Well, Nvidia you brought up Nvidia. Wasn't Nvidia also more of an attached a proxy play to Ethereum then? Because Ethereum, you needed to mine Ethereum, you needed a graphics card, right? So Ethereum,
most of the cars that Nvidia sells are, you're exactly right. So, but here's the thing, that in their last earnings, Nvidia kind of had a buy the news rally because it had gone down a lot into the earnings. They didn't really mention that. They didn't really mention the weakness in the mining, but this dump in Bitcoin from like 30 to 20,000 and Ethereum going back to 1,000 has happened since. So I think you're going to see that in their next quarter. And they didn't really mention weakness in the kind of crypto segment of their business in the last quarter. So that's another reason I remain kind of short on that. And I'm talking about the pre-COVID highs. Well, the pre-COVID highs on Nvidia are $75, which is still over 50% from where it is. And Nvidia in every bear market, like 2000, 2007, 2008, usually goes down 80 to 90%. So it's just like a high beta stock. So
it's super risk on. When it runs, it runs.
Yeah, when it runs, it runs. And this one is even, because if you look at Nvidia, it's kind of like people talk about what's the poster boy. A lot of people use Tesla because of Elon Musk and electric cars. I tell people it's actually Nvidia because they're in everything. They're in crypto. They're in like gaming. They're in metaverse. They're in AI. They're in like any niche kind of sector that anyone who's kind of like the uber bull on technology loves. And I remember I had a guy, one of my subscribers, like when I shorted it late last year at around 300 a share, like he was like attacking me and saying he bought calls on it just because I bought puts and this and that. And, whatever, I don't really care, but it's just like, it was only one person. So it's not like everyone thought this way, but I think Nvidia is a really good proxy for this. And look, they're doing a lot of good things. And it's probably the kind of, we're going to talk about maximum pessimism at some point. Probably when Nvidia is $20 or something at the depths of a bear market, it's probably a good buy. But we're nowhere close. They're like at the top, Nvidia was trading at 30 times sales, right? It's still trading at like 15 times sales.
And most people who are who got a stimmy check or just started investing in the last couple of years. They haven't had experience in a bear market before. They started buying stocks in 2020 and 2021, either when they were cheap or they're already going up. So they bought high and sold higher. And these are very common mistakes for a lot of beginners or retail investors. They buy high and sell higher. They don't understand the fundamentals. They don't understand what could trigger a bear market. And normally, as Dave outlined, it's central banks hiking interest rates. That's when things start to really, really break. And then you go very, very quickly from super overvalued parabolic stocks that are high betas and high risk on, you go to risk off, you go to margin call selling, because a lot of these traders, and Dave, we were talking about this too, I was getting screenshots from girls on dating apps that were bragging to me that they were spending an hour or less per day, making $100 to $500 per day trading altcoins. And they didn't know anything about the altcoin. It was easy money for them. And they were like, oh, you have 15 years of financial industry experience. I'm making more money than you. You're a moron. You don't know what you're doing. And I was like, oh, I'm going to be glad when there's a bear market and these things collapse and you don't know what the hell you're doing.
Oh, I had same thing. These like kind of younger girls like writing me stuff, or younger people writing me stuff like coins that were doing something for like save the whales, and NFTs and all this kind of stuff. And I was just like,
they were trading on margin. They were trading on margin. So they're the Coinbase and the other brokers and Robinhood, they were trading stock options. They were trading regular stocks. The Robinhood app and other stockbrokers were giving them margin. Coinbase and the other crypto brokers were giving them debt credit to trade onto. It was not going to end well.
No. And like to me, like that stuff is totally like the tulip mania, the Dutch tulip mania, like that NFTs, all that stuff was like the ultimate in the in the kind of mania. And I think one thing too, like, and I hate to spoil the party for like crypto bulls or crypto nerds or whatever you want to call them, is that one issue with this phase of the bubble is like the mass, the people like adopting it en masse. Like that really reminds me of one of these classic manias, like tulips, like 1929, like the Mississippi scheme or South Sea bubble.
Beanie Babies too.
Yeah. Beanie Babies. It's like one of these things where it's so adopted, like, we were sending messages about Trevor Lawrence losing 60% of his signing bonus, and other guys like Russell Okung and even like Tom Brady and Aaron Rodgers were all pumping crypto. And it's just like when I see it on that kind of mainstream platform, I'm just like, this is a total mania. Like these are guys who be sticking to throwing or whatever, playing football, and they're pumping all this stuff.
When I saw the Super Bowl commercials, to me, so all those crypto,
it was like 2000 and .com.
Yes, it reminded me. So all those, the arena changing its name in Los Angeles where the Lakers play and the Clippers play to crypto.com, and then all the Super Bowl commercials. I said like 6 to 8 months from now, we're going to have a big crash because they're spending millions of dollars wasting on stupid advertisements instead of running their businesses.
Yeah, where I first got that part of it was, I think it was college football. The main sponsor at the halftime show was crypto.com. And I didn't even know what cause I go to Coin Market Cap or whatever to look at it, but I didn't even know what that was. And I was just like, they are sponsoring the college halftime, football show. I can't remember which network it was. If it was CBS or whatever, I can't, so don't quote me on that. But I just remember seeing that crypto.com sponsorship, and I was like, are you really kidding me? Like, this is like the total top, And then there's this football league, which is like indoor football league that T.O. and Manziel play in, where the fans get to pick like the plays. It's basically an NFT league. Like all the teams have like kind of NFT names and stuff. And it's like when you're seeing that kind of thing, like there's so much money being made in these like little bubble sectors, it's usually the sign of kind of like a top or whatever, right? So,
and when the tide goes out, you find out who's swimming naked because there's just too much.
This league. I'll get it right now. It's like called like the fan football or something like that, fan controlled football. That's what it's called. So like, it's just like, I don't think you'll see it after this year. I think next year when it comes around, kind of be like the XFL or USFL, they'll be like, oh, there's no money for it anymore because, the NFTs don't have the money, excess cash to do it anymore. Right. And another thing with crypto that really like kind of like irks me about it is, for all the talk about decentralization and this and that, when I kind of look at it, right, which, and again, this is the thing that kind of bothers me, is that basically like, Binance bought a bunch of Bitcoin to support the price over the weekend when it tanked, below 20,000. I'm like, well, Binance is equivalent of like, I don't know, the NYSE or the NASDAQ. The NYSE is like, a publicly traded company. The NYSE wouldn't turn around and buy spiders or diamonds. They're just kind of like, they make their money, like whatever, from the fees from companies, blah, blah, blah. They're not turning around buying the stocks in the exchange to support the exchange. I think it's a total conflict of interest, just trying to probably keep their investors, and also like, the people that have money in the cryptos in their accounts.
The stable coins are even worse. I mean, there's tons of hidden leverage in there. There's a lot of allegations of money laundering, and how in the Caribbean, like the banks that were handling Tether, like there was one retired investor, and where Tether listed their main bank headquarters in the Caribbean. He said he walks by it every day, and he said for a bank that's supposedly handling tens of billions of dollars per day in transactions, there was less than 10 people there in a piece of shit office space. So there was a lot of red flags there with the stable coins and the hidden leverage and the other stuff. So hopefully like the bear market will weed a lot of that stuff out. And then the people who legitimately believe in crypto after the waste is gone, they'll come in and they'll buy, and that'll put a bottom in the bear market. I don't think crypto is going away, but there was way too, as Dave and I talked about in the last 20 minutes, way too much excess, way too much credit, way too much excess, way too many people who didn't know anything about the technology or altcoins. They were day trading profits, making enormous sums in only an hour or two a day. I've gotten screenshots from some people who are making thousands of dollars in day trading, and they don't know anything about any of these altcoins. Those profits will go away because that's not how markets work. It's not going to be indefinitely with central bank asset price inflation, where you can make that type of day trading profits every single day and you don't know anything about the assets.
Well, like the last thing I'll say before we move on for crypto is that one thing that bothers me about it too is that 3 of the top 6 coins in terms of market cap are these stable coins. You're talking about Tether, USD, and Binance. And it's like, well, if the whole point of crypto is like, that it's supposed to be this like speculative asset class, and this this new kind of technology, it's like, why are 3 of the 6 top coins that's basically linked to the dollar? And also, you're supposed to buy crypto as a hedge to dollar valuation, which, by the way, is total BS. Crypto is just linked to the NASDAQ essentially. But
crypto's risk on. Yeah, crypto is very highly correlated. It's risk on. My buddy Aaron, he's done the charts. Yeah, it's highly correlated. The other thing about the stable coins is the stuff that the stable coins were buying, besides just Bitcoin and the other price and the other things to stabilize it. They were buying US treasuries. They were buying junk bonds. They were buying like a bunch of things that you wouldn't associate with Bitcoin.
Totally. So that's kind of my issue as well. Is just like I think like those stable coins are going to kind of have to go, like you said, before there's a reset and this and that. And I don't think everything is as simple as, in 2013, when the first the top kind of happened in Bitcoin, just over 1,000, and then 2017 to 20,000, and this last top, I don't think it's simple to say that it's going to work out that, Bitcoin's going to keep having these huge spikes, fall 80%, and then have another huge spike. I think at some point, it's going to underperform for years and years and years. So, and I think one thing too is like you're talking about, like when the water comes out, you'll see who's naked. Let's see what happens, because I think when you see the amount of scams, frauds, and Ponzi schemes that have been going on in this cycle, I think that's going to kind of like deter people from crypto for quite a while. And I think too, like, also, again, talking about the younger people, the millennials, the Gen Zers who buy this stuff, seeing people like Trevor Lawrence or these athletes losing money in it is also kind of a bit of a wake-up call as well. Somebody told me there's some MLS player who lost even more than Trevor Lawrence. I'd have to look it up, but like, it's just like, I think like, it's going to be kind of a wake-up call. And remember, like, in my opinion, if I'm right, and some big hedge fund managers have said this as well, I think we're in a 50 to 60% drawdown in the equity markets ultimately. So like Bitcoin will probably fall a lot more in that kind of scenario. Let's get back to that, because Bitcoin's fun to talk about, but like I'd rather talk about, like, I don't no offense.
I'd rather talk about other contrarian
real
ideas
markets.
What did you say?
real markets.
Well, you and me are more fundamental guys, so we look for contrarian stuff. Sir John Templeton was going into balance sheets. He was looking at profit margins and cash flow. He was looking for severely mispriced assets where the baby was thrown out with the bathwater. I mean, he bought a lot of Dow stocks during World War II. These were profitable companies that the market had thrown out that were still making a lot of money, that had big dividend increases. So he had a long track record of finding mispriced assets. And over time, he produced enormous returns from that. For listeners who are not familiar, he was one of the most famous contrarian investors in the history of investing. So David, in your opinion, what are the biggest risks to the global economy right now?
I think higher interest rates, even if rates don't even go up anymore on the long end, because people don't realize, that people look at 1994, and Mexico needed a bailout, or these other like tightening cycles. But the issue now is, even the 70s, when rates went to double digits, when inflation was high. The problem right now is, quite frankly, is rates. The government debt is so high, rates can't go where they were back in the 70s, because for example, the debt to GDP in the 70s in the States was like 40%. Now it's 120%. So like 4 to 5% on a long bond, the US government's broke. One reason the Japanese have to keep buying bonds at 0.25% on the 10-year bond is because if that 10-year bond in Japan goes to 50 basis points or 1%, Japan is done. They're toast because their debt to GDP is so high. And then also that goes to consumer level. Like, I'm from Canada originally, and there's so much mortgage debt and personal debt in Canada. Like I read that like 1 in every 5 or 1 in every 4 houses in Canada now, if rates go any lower, they're done. These people are done. They cannot afford the mortgage payments because the housing prices are so high. And then, their interest payment will like go up so high because a lot of people in Canada use line of credits for their mortgages, right? Not even like adjustable rate mortgages. So that's gone from like 2% to 5%. So if you got $1 million mortgage, well, that's gone from 20 grand to 50 grand. And these people cannot afford that, So I really believe in the West that's the problem right now, where we cannot handle these higher rates because of the indebtedness, especially in the English-speaking world, like UK, US, Canada, Australia, of the homeowner, and then just as the governments as a whole in the West. I think one reason they had an emergency meeting at the European Central Bank a week or two ago wasn't because of maybe we should raise rates faster because of inflation. It was because the Italian bond is 4%, the Portuguese bond, et cetera, and these countries are so indebted. If you start getting to 4, 5, 6% on their interest rates, they're done. Like Greece, by the way, is going to go bankrupt again because Greece, didn't really solve their problems during all those bailouts. Like Greece is basically
they got their assets stripped. None of their actual problems were solved.
Their debt to GDP is almost 200%. It's almost Japanese levels.
Dave, you talked about the housing bubble in Canada. Have the Canadian banks crashed yet, or do you think like the Canadian government's going to have to change the accounting rules like the U.S. government did and the FASB did for the large U.S. banks, where mark-to-market accounting was suspended or changed to mark-to-model? Do you think that's going to have to happen then for Canadian banks to save them, or do you think like the Canadian banks, some of them are going to fail?
Well, first of all, the Canadian banks tend to be like a little more conservatively run, even though obviously they probably have too much exposure to the housing market. And the Canadian banks, there's only 5 or 6 of them. It's not like in the US where you have all this competition and the state banks and credit unions and this and that. So that's one thing on their side. But the problem is, again, like you're saying, is exposure to the mortgage market and the housing market. The biggest problem in Canada is not actually like Canada hasn't been doing the subprime loans like the US did in 2006, 2007, teaser rates and ninja loans and all that sort of thing. The biggest problem in Canada is, like I said, the consumer is so indebted with these high home prices. And here's another problem. See, in Canada, like in the US, like whatever, you go bankrupt, you sell your house off, you kind of start over again. In Canada, if like you're forced to sell because you can't make that mortgage payment and whatever, say you sell your house at the lower price. So let's say you sell your house at $700,000, you bought it for $1 million. and say you had a mortgage of 800 or 900 grand, you still owe the bank the extra money, right? You're still on the hook for that. So I think they might get rid of that law that basically like, if like, you owe that mortgage, they might
otherwise the banks will get stuck with inventory then and the prices will be falling.
They might just make the banks eat it and then also give a bailout. And I think a few years ago they did something that kind of was underneath the radar. You just have to do a Google search to see it. They did bail-ins in Canada. They basically like passed a law. So a bail-in, basically, for people who know what it is that if you have a couple $100,000 in a bank, you're a wealthy person. That basically, like, they can just say, okay, we're going to take 10 or 20% of your money because that's going to subsidize our losses, right? So I think they did that to kind of support this, like, which is interesting because they did that way back, I think, like in 2018 or something like that. Like they did a few years ago, right? So it was almost like they did that kind of knowing that things might not play out. And so just so you know, my biggest short or my favorite short right now is Home Capital Group. This is a subprime lender in Canada. And I don't know if people know who Mark Cohodes is. He's a big short seller. He kind of exposes frauds. And he was short this back in like 2015, 2016. And the stock almost completely collapsed. Actually, Warren Buffett came out and basically bailed him out in 2017. It wasn't even because of the housing market. It was just because they were doing all these fraudulent loans and giving like dead people loans and just crazy stuff, right? And then
so basically copying Wells Fargo. Then,
yeah. So, but they're a subprime lender. Well, just think if like a prime loan has gone from 2 to 5. What has the subprime loan gone from 6 to 12? And those are people that can't really, like those are people that are lower middle class to even worse, right? Or could be on welfare or unemployment or whatever. So I think that you're going to see the next quarter in Home Capital Group, and I've already done pretty well on this. We started shorting it around 34, 35. It's about 25 now. So it's down like 30%. I think you're going to see real struggles in their next quarter. And by the way, one of the ways that something like Home Capital Group gets money, they do like these interest payments on their bonds of like 5-6%. So that way people buy those, which brings money into the, to the institution, and then they can loan that out at whatever. But okay, when interest rates were 0, they could do that at, they could pay out 3-4% and then loan out at 6. But the problem is now they've got to, offer 5 or 6 because long-term government bonds are 3 or 4, and they got to loan out at 10. No one's can afford a 10% interest loan in Canada right now, because like the average home price in Toronto is like 1.3 million, which is that down, by the way, at the peak of 1.7. I think it's close to 2 in Vancouver, and even in places like Montreal or Calgary, it's actually much higher than the average market in the U.S. So I think that's like I said, one of my favorite charts, and I think that's kind of like the embodiment of what's going on. I think then this gets back to like if you want to talk about geopolitics for a second and the war, like in the 80s when we bankrupted the Soviet Union by the U.S. working with Saudi Arabia and crushing oil prices, and oil was a big way that the Soviets kind of funded their whole system, the oil revenue. The problem now is that back then the Soviets were like this failing empire with all this debt that couldn't sustain themselves when that revenue source dried up. But now it's a lot. I think we're finding a lot more difficult to bankrupt Russia because Russia has very low debt. They're getting all this money from oil coming into their coffers, and all the Western European countries not only are dependent on whatever cheap Russian energy, but also they have these huge debts. And now with inflation going up and interest rates going up, these countries can't afford it.
There are so many problems, Dave. So the question was, what are the biggest risks of the global economy? I mean, there's so many. I just said I think it's debt. I think debt. I just think I explained that. It was debt and interest and that sort of thing. So and I think like something that if you ask 10 different hedge fund managers, you get 10 different answers. Is a lot of it would depend on what collapses first. So are emerging markets going to collapse first? Is Japan going to collapse first? Is the European Union going to collapse? Any bailouts? Whose banks are in the worst shape? So Canadian banks, since we were talking about them a couple minutes ago, I don't think they're making trillions of mortgage-backed securities like American banks are still doing, although the Fed's buying them still, which is ridiculous. The Fed's subsidizing additional bank profits by buying more mortgage-backed securities and then moving them off balance sheet into special purpose vehicles. So I don't think the Canadian banks are quite are playing in the derivatives, over-the-counter derivatives market at the levels that U.S. and large European banks are playing.
I think the biggest risk, if you're talking about like a systematic risk, I talk about interest rates in terms of a country is Japan, because Japan is still one of the largest countries in the world, but it's also one of the, and obviously a huge exporter of steel, automobiles, etc. And it has this huge debt problem, and they've been devaluing the currency. And the problem with Japan devaluing the currency is it's not like in the U.S. where like you've got mines all over the country and you can produce your own, aluminum, steel, copper, whatever.
Japan, we have a lot of natural gas here, too.
Yeah, natural gas, energy. Japan has to import all that. So that really hits the margins of these companies when, just think of your gas bill, if you're an American or Canadian, you're listening to this, and then just think if you're in Japan where like, okay, gas is up, plus your currency's down 30%, like that makes it even worse in yen terms, right? So I think Japan would be the country I'd look at. The thing about emerging markets, can emerging markets have like some debt crisis? Are places like Turkey and Argentina going to be in trouble? Yeah, of course, right?
Well, it depends on the dollar. So if the dollar, because there's so much dollar denominated debt, if the dollar continues to rally and the Federal Reserve Bank doesn't give these dollar currency swap line loans out to these emerging market central banks and then waive the loans later, then these emerging markets will have problems if the dollar continues to rally. I also think there's a lot of problems in China that are being covered up. They have serious food shortages. Their costs for electricity and energy are up enormously. There's also shortages. I mean, really for 18 months now, a lot of factories in China, a lot of them have not been running because of the energy and electricity crisis in China, because there was not enough energy and electricity for both factories and to supply major cities in China with power and electricity.
Well, also you got to remember China, they're having a housing implosion similar to the US in 2008. That's why China is cutting interest rates, even at a time higher inflation, because they're trying to bail out their housing market. So that's another issue going
too. The Chinese banks need bail. There's videos now of like bank runs in China, and they're restricting withdrawals, and that's because of the real estate prices, like you just said. So Chinese banks, they give out tons of construction loans, real estate loans, all of the collateral in the Chinese shadow banking system, Chinese banking system is all based on higher real estate prices.
And also too, but just quickly to get back to emerging markets, we'll go to China now for a second. But I don't think emerging markets are going to be the systemic risk, because if you go look at, they really underperformed since 2011. Like I think they've underperformed by like 2/3 percentage wise compared to the S&P 500. So I think actually they're actually relatively cheap, and they'll fall. Don't get me wrong, especially if the U.S. keeps raising interest rates and tightening monetary policy, but I think that because they are already so cheap, it's not going to be like 97, 98, where they're going to be the epicenter of a crisis. It's like they're actually going to be probably what to buy, kind of like similar to the 97, 98 or the early 2000s after the dot-com bust. Emerging markets, from 2002 to 2007 outperformed the S&P a great deal. I think that's actually going to happen again. So the great thing about emerging markets is you have all these huge dividend paying companies as well. But to get back to China, I think China is another risk, because I think they're kind of like, they're a house of cards and it's being exposed right now. And I think part of the reason these lockdowns are happening in China, because China almost had no COVID cases in the last 2 years, even during Omicron or whatever, Delta and all these other variants were spiking everywhere else around the world. And I think now mysteriously they're having this spike. And part of the reason is to cover up the weakness of the Chinese economies. They can just say, "Oh, we're having shutdowns due to, due to COVID." But I think China would definitely be another risk, especially the biggest risk out of all those emerging markets. And I think that Chinese real estate market is the real problem. The problem with China, though, is that the numbers are so bogus and fake. Who knows how much longer they can play pretend, until you actually see it,
Their official consumer price index inflation rate in China is 2%. That is,
and they still say they're growing at 4 or 5%. It's like, come on, how can you shut down Shanghai and and the south of the country, like the richest, parts of the country?
Well, all these governments are committing economic propaganda, but some governments is worse than others. I mean, 2% consumer price inflation in China is ridiculous. We were discussing before we started recording, you were telling me you think that Japan is way understating what their inflation is.
I think they're doing the same thing. They're saying it's 1 or 2%. It's like, we know Japan's always had this issue with deflation for, since the bubble burst in 1990, but it's like, come on. With Japan being such a huge importer of raw materials, there's no way that inflation in Japan is 1 or 2%. No, like Japan's a weird country in that things like real estate and like the raw materials are very expensive, but things like food are very inexpensive in Japan, right? So Japan has kind of got this a weird contradiction that way, but there's no way, even with all that, it's like Japan is got 1 or 2% inflation. That's total, excuse my language, but that's total bullshit.
And especially when the Japanese government is still subsidizing, they were handing out energy rebate or debit cards for people to continue buying gasoline or diesel, and energy prices are still very high. I think a big theme for this with the high energy prices, high electricity prices, high diesel prices, high gasoline prices all over the globe. I mean, that's putting a lot of cost pressure, a new normal, much higher cost for a lot of different businesses, whether that's mining, agriculture, transporting goods. The cost structure for a lot of these businesses that rely on energy is up enormously.
Well, I think that's one problem with mining right now. People would say, gold at 1,800, even as a run, you can make money at that. Copper at $4. So I think there's two factors. Especially in kind of we do some stuff in the smaller and mid-tier sector. Is that the two major factors are, number one, like you said, input costs. Oil and gas, diesel. Buying a new tractor or a drill, that's very expensive now because of raw material costs going so high. And then number two, because a lot of these companies are more capital intensive in terms of like they need to raise money. If you go look at all the junior market like booms, like 78 to 80, 85 to 87, 94 to 96, 2003 to 2007, 2010, 2011. And then, there was a little mini boom back in after COVID, 2021, 2020, 2021. They all coincide with a rising stock market. So as much as like you think gold is a contrarian investment, which it is to a certain extent, gold itself, with the junior miners and smaller miners, they need liquidity. They need access to capital. They need to raise money, so that's another issue. So you got, like you just said, all the input costs are way up. And then now it's tougher to raise money because, the market's been going down for 6 months and interest rates are going higher. So it's like kind of difficult right now. But I do think, again, we're talking about John Templeton, John Templeton never bought like junior miners. I think he did buy some mining companies in the early to mid 90s that, just big base metal companies. But like, I think that like you're getting to the fundamental standpoint where many junior miners are cheap enough to start like entering here. But I think that's the issues they're facing is the high capital input costs combined with like liquidity issues. And then also too, with like much of the world, because in this kind of populist revolt we're seeing against inflation, that's another issue, as well, that, like Colombia, which has been, with all the problems Colombia's had, with whatever drug lords, et cetera, throughout the years, Colombia was the one country that strayed away from going to leftist socialist policies in terms of their politics, and they just elected a leftist. And Chile's done it, and Peru's done it, and Brazil's got another election this fall. They may do it again. So that's the issue as well. And of course, the reason I'm mentioning these countries is that these are huge countries in terms of mining and metal production.
So you're saying that there's going to be some supply side issues, but they won't be based on the free market necessarily unless capital dries up or commodity prices crash and stay low. It'll be more about geopolitical risk, about the politicians changing rules, regulations, raising taxes. When the copper price was a lot higher in countries like Chile, they put a giant copper royalty on. I think Panama also lately, because they have a few large new copper and gold mines, they put a high copper royalty on as well. So if you put these types of punitive taxes on at a high commodity price, when commodity prices go down and the copper price is corrected, these taxes are going to be even more prohibitive, even more punitive, and they're going to prevent mining companies then from making reinvestments back into the mine, especially because the mines with the higher cost that you said, they're not generating the free cash flow. Now that you said about free junior miners, I mean, at this point, Dave, junior miners to me, especially if capital is not available for a lot of these juniors, I would just avoid them entirely. There are such amazing discounts for mid-tier gold miners. These are companies that are low-cost producers. Some of these mid-tier gold miners, they're going to get bought in the next 6, 12, 18 months by larger senior miners and need to replace reserves and have a lot of cash on the balance sheet.
Because now we're now in another cycle where, most junior miners or mining miners in general, I want to expand on this in a second, but most miners peak between, say, the middle of 2020. Just rallied like a huge 3-4 month rally off the lows of 2020 into like mid 2021. So, and there was in the majors, there was a little bump back when gold went back to 2000 during the first part of the Russian Ukraine war. But if we go look at these things, now we're in that cycle, and you're exactly right. Like if you go look at the cycle of miners, it's large caps, mid tiers, and then the juniors, come along for the ride. So I think right now, even though I own some juniors, I'm going to hold them right now because, like I said, I've been making money on shorts and the whatnot. And I got ones that are well capitalized and they're in no danger of going under. I think right now you still kind of want to wait a little while till that new upcycle starts. And when that new upcycle starts, you'll probably see the majors and the mid tiers take over. And because a lot of these mid tiers are so cheap, I would agree with you. I would think there's going to be a lot of consolidation at some point. And I've seen on your Twitter, you've mentioned too, that like, look, if you really don't want to think about it and you really don't want to try to trade this stuff, the best ones to invest in are the royalty companies, because they just get like a stream of income and they don't have to deal with all the issues with costs, with political issues. They're just kind of like, they're well diversified. They have a bunch of mines that are paying them income, and it's kind of just like printing money. So that's what I look at. And the big ones are obviously Royal Gold and Franco Nevada, but there's an interesting one that trades on the NYC called Metalla, which is a smaller kind of cap a royalty company. So people might want to look at that as well. So, but it's about $5 a share. But I would basically, if someone really just wants some mining exposure and doesn't want to think too much about it, I totally agree that royalty companies are the way to go. And I agree with you. Because we're in this down cycle, the up cycle, it's going to be a little while, before the juniors participate. But here's the last thing I want to say here. I mentioned those bull market cycles, like coming when the Fed finally does pivot, which still might take another year or something. But when they do raise rates to whatever, 2.5%, 3%, market tanks, everything tanks. Out of the bottom, almost always the next 2-3 years, the precious metals are almost always the best performing sector. So like that, I'm talking like 03, 04, 2009, 2011.
And some of those juniors could be, to add to your points there, Dave, some of those juniors could be 10, 20, 30 baggers. The problem is picking out which ones and then trying to figure out the bottom, because if we're nowhere near the bottom, some of these juniors, some of them could go bankrupt, some of them could go down another 50, 60, 70%. Some of the management teams, and a lot of people aren't aware of this, the management teams, while they go on public interviews and YouTube channels and podcasts and Kiko interviews, they could be saying nice things about the company. They have plenty of cash. Meanwhile, the management team behind closed doors is working desperately to sell the junior mining company for pennies on the dollar. So that is the risk with juniors, that the average retail investor does not understand. You've been in this industry, Dave, longer than I have. So I'm sure you've heard the stories. I've heard just crazy stories about how someone goes on TV or an interview or a podcast or YouTube video, says the company's fine, plenty of cash. A month or two later, the management team has sold out for pennies on the dollar. The shareholders are getting screwed. The management team made an extra tens of millions of dollars because all their stock options were picked up.
Yeah, that happens in the sector. Yeah, definitely. Yeah, no, that 100% happens. But I don't really have that experience recently because I've been doing it for like 20 years in that sector. So most of the companies I'm investing in have really good management teams and can kind of survive bear markets. And I remember I had a company called Avion Gold. They were in Mali in Africa, and they went from 6 cents at the bottom, and they took over an old mine from Nebsun. And they ultimately went to $2. I think they ended up getting taken over for 80 or 90 cents. So if you can find the right companies, but here's another thing too, just because I know a lot of junior investors are like, oh, juniors are way down, blah, blah, blah. They're cheap. But the problem is right now they're kind of in this no liquidity trade where people are disinterested. They're following on low volume. And I remember that happened in the summer of 2008. And then they got flushed out even lower in in the fall of 2008.
And 2009, and then 2010 we had a big rally. I remember some of the juniors I bought, and I haven't bought juniors in many years, but the juniors I was buying in 2009, 2010, some of them by the peak of gold and silver in 2011 were up hundreds of percent. But then
I remember being at the PDAC, the big mining show in Toronto in March of 2010. And I remember just being there and talking to guys, and the guys were like, I can't believe how fast the industry came back, right? Because just a year and a half earlier, everything was decimated. So that's the thing about it. So you have to kind of pick and choose. My opinion, juniors is I did really well. From about 2018, 2019 to 2021, is you just kind of got to be patient. And I raise money, I help companies raise money, et cetera. I do a lot of venture capital for them, but I really haven't done a deal in months and months and months, or because I'm just kind of patiently waiting for a good opportunity. Part of it is I know there's not going to be a lot of interest when I do a deal too, but also I know I think it's a little early. I wouldn't really want to do one this summer.
Well, also, Dave, if you put yourself in the shoes of a producing mining company, say you're a senior miner or a mid-tier miner, you're looking to replace reserves, you're looking to grow, you have some free cash flow, you have pretty good profit margins. Yeah, your energy costs and your costs are up, but you still have a good margin right now. You don't want to go buy a junior because the cost to build a new mine is up enormously. Why would you want to pay 50, 60% more to build a new mine when you have all these supply chain problems, when you can go on the stock market right now and go and buy a heavily discounted mid-tier gold miner that's producing free cash flow at good profit margins, and there's a handful of these companies that are extremely discounted. So my point is that those companies are going to be taken out first because you can buy extremely discounted cash flows with good profit margins, free cash flow at a low valuation multiple. Those companies are going to go first before the juniors start getting taken out, the ones who are very close to a feasibility study and a construction decision to build a mine.
Yeah, I would think the only reason that you would want to put in a junior should always be a small amount of your capital anyhow, is that because once you do get one of these ultra depressed kind of moves like the early 2000s, like 2008, 2009, say 2015, is that many of these stocks can go up 100, 200% just off the lows. But again, you're talking very small micro cap type companies. So it's not something if you're someone that's got a little bit of capital, and you can allocate hundreds of thousands of dollars into the mining sector, this is the kind of thing, let's say for argument, you get 100,000, you could just, I can put this all in miners. Say you're worth millions of dollars. It's the juniors out of that 100,000 should probably be 10 or 20 grand. And you could spread that out over 10 or 20 companies, right? Just put $1,000 or $2,000 in a bunch of different deals, right? So that would be my only argument. I'm not going to say against what you're saying, but for juniors more that, look, when they're that beat up, they can see the 100, 200, 300% gain off, but that, those levels, but you got to really wait for that kind of maximum pessimism or that, that kind of panicky kind of trade to occur. But if you're looking at right now and you have a 2-year horizon, yeah, you're probably better off in the mid tiers because they have a better probability of being taken over. They have a better probability of staying alive because they have cash flow. They don't have to raise money and dilute, all of those sort of things.
So I want to transition now to the remaining part of the interview. We're almost at an hour, to Brazil, Petrobras, contrarian investing opportunities in different countries and sectors. One of my listeners asked me about Petrobras. I started taking a look at it. I haven't looked at it in a while, but a lot of these small and mid-tier oil and natural gas producers, the last couple of weeks, they're down 20, 30%. A lot of them are minting money right now, free cash flow, even though the oil price has corrected a little bit. The U.S. natural gas price is still really high. A lot of U.S. and Canadian oil and natural gas producers are still making really good free cash flow right now. Petrobras as a speculation. I want to just talk about some of the fundamentals, and then you could give your opinion and maybe talk about Brazil. The net debt for Petrobras, it's down over the last 3 or 4 years from $70 billion in debt, which was a lot. It's down to $18 billion, and they're paying off the debt really, really, really quickly. They have a price to earnings ratio. I think it's below 3 now. And then their dividend yield is absolutely enormous. So do you think, for risk reward, buying a point of maximum pessimism as a contrarian investor, do you think then that Petrobras, in your opinion, has some appeal?
Yeah, totally. The issue you get with these type of companies, is that I think, and the Russian companies, like, obviously now they don't trade because of war, but they always had this like big discount to them because political uncertainty. They were kind of like, seen as kind of like, like companies that were run by politicians, and and kind of like kind of corruption, etc. So they would have these huge amounts of profits and big dividends, but they would trade at these ridiculous valuations. But if you're just looking at it, and obviously I don't think Brazil is going to politically end up like Russia. I think all their ADRs and all their stocks are going to be allowed to trade. The amount of cash flow they're producing, like you said, they're paying down their debt, the huge dividend. And if you just look at it as a pure dividend play, one thing I told you off air was, well, if you're going to make 40% or 30% a year on a dividend, like Petrobras is paying out right now, it's like you can lose 10% or 15% a year in the stock, and you're still going to be making whatever 20, 25, 30% return. So I definitely think I wouldn't go all in, because I think that, like, we talked earlier about the Fed tightening. I think that will cause some kind of decline in oil prices to whatever 70, 80 a barrel or a little lower, and then you'll get to buy PBR lower. But if you're looking at a dividend play and a cash flow play, definitely say maybe buying a little bit of a position right now and then averaging down if it goes lower, I think is a legitimate thing. Like, and I know that the current government, because is more of a conservative government right now in Brazil, they're actually looking at privatizing it and maybe spinning it off into a couple of different companies and getting the kind of government interest out. Now, if the socialists were to win in the election this fall in Brazil, that's probably not going to happen. But if that would probably be even more positive for PBR. But definitely, when you see that kind of dividend, you're going to want to look at that. And one thing about these companies in these kind of like third world emerging markets, especially in, you might say, oh, these countries are basket cases. But unlike the West, where now we're entering this period of volatility, but like where companies are used to stability, when you look at companies in Argentina or Brazil or Turkey, these countries are used to putting up with currency devaluations, high inflation. So in a lot of ways, I find these companies are actually better run because they've gone through.
They're more resilient.
Yeah, they're more resilient. They've gone through, like I really like TIO, which is the Argentinian telecom company, which also pays a big dividend because they've been through currency crashes and crises and all this sort of thing. And the country, the company's still able to pay a nice sized dividend and make money, etc. So I think that that's like resilient is definitely the word for it. Like I would look at some of these countries, and if we do see another leg lower ultimately in the stock market, whatever it is, 6 months from now, a year from now, I think these are the kind of companies you want to buy at the lows, because not only will you be getting like a discounted price to obviously what the true worth of the company is worth, you're going to get some huge dividends as well. And remember, as things recover, they will increase those dividends. So we were talking about PBR. What happens if someone had bought PBR at that low? I think it was $3 or $4 a share. I think back in 2015 or 2016, or it hit 3 in 2020 during the COVID crash. Well, like with this thing paying 40%, so roughly $4 a share, you're getting more than 100% a share in dividend if you had bought near the lows in 2020. So that's the kind of thing you can do as well. Like I mentioned TIO, the Argentinian telecom, during the Argentinian currency crisis of 0102, that hit 25 cents a share and ultimately went to like $30. But it's like $5 now. But like I think they're paying like 60 or 70 cents. Again, if you had bought near the lows, you'd be getting your initial capital back every single year just on the dividend, right? So that's the kind of things. And I don't think even when dividends rise again in the American, North American, Western European markets, I don't think we'll see them at those levels. So these emerging markets, and by the way, that was John Templeton's big thing, by the way. He was kind of an emerging market, an expert. He bought the South Korea and the Asian market during the '97 crisis in those countries. I think you get these capital gains plus these huge dividends that you don't get in the developed world. When you're buying at these bottoms, in markets.
I also think what could happen with dividends, I think this might surprise people, especially like traditional value investors, is we may see with higher labor costs, higher energy costs, stagflation, the consumer is tapped. We may actually see these consumer staple dividend companies that a lot of pension funds and larger institutional investors are used to increasing their dividends. We may see dividend cuts in the next 18 to 24 months, depending upon how the economy plays out. We may see dividend cuts from the larger consumer staple companies. And to add to your points there, we may see then dividend increases for the commodities bull market in some of these emerging market countries and miners and oil and natural gas companies. Although in the short term, things may go down, but I think we're still going to see a commodities bull market long term for food and energy. Although in the short term, I think there's going to be buying opportunities. An important point, though, for Petrobras, you talked about buying it now. If you go out and listen to this interview episode, this is a common mistake for retail investors and beginner investors. Do not buy all of your stock position at once. So
I think in a bear market, that's really important to note. Like the perfect example is during the bear market of 0809, like the best buys were the casino stocks because of their debt loads. A lot of them almost went bankrupt, right? And like Las Vegas Sands, Wynn, all those kind of stocks. I think Las Vegas Sands went to $1, $2 a share, and eventually went back over 60. But if you had just bought all your Las Vegas Sands at once, so say when it was 10 because it was down from 50, you still saw it go down another 80%. But if you had kind of averaged in, bought some at 10, bought some at 7, bought some at 4, bought some at 2, you would have a nice like kind of average in price, and then had more of a gain off the lows. Another thing too is remember when you're dollar cost averaging, it's just simple mathematics. Like let's say you have $10,000. Like I'll use this Las Vegas Sands for example. Say you bought your first position 2,500 at 10. It's 2,500 shares, obviously, right? Or sorry, 250 shares because times 10 is $2,500. But a dollar at 2,500 would buy 2,500 shares. So actually, it brings your cost down even more because you'll be able to buy much more shares at the lower cost. So that's kind of another thing to look at, as well as like always kind of averaging because you never know how low these things are going to go. And one of the factors too, in kind of this kind of like buying cheap companies is I always look for companies that are down 80 to 90% from their all-time highs. I don't know if you ever heard of Maybank Faber, but so this is not Mark Faber. This is another guy who runs a bunch of funds in the States. So Maybank Faber has a study, and I refer my subscribers to it all the time. And essentially what he shows is that when you buy an asset class that's down 70, 80, or 90% from its highs, the 3-year return is always like 100, 200, 300, 400%, So like that's another thing as well to kind of look at. And by the way, I think because casinos have high levels of debt, Obviously, they're very cyclical based on what the economy is doing, disposable income. I think these are the kind of they've come down quite a bit, but I think they still have more to fall. I'll be looking at buying those again. Like Win, for example, its high in 2018 was almost 200. It's 52 now. But if Win were to get to $10 or $20 a share, I would totally buy Win, so or Las Vegas Sands as well. So these are kind of like leverage plays you can do as well. But like I said, you kind of have to be very patient, and you really have to do the thing where, that Warren Buffett thing where he says you have to be greedy when others are fearful, and fearful when others are greedy. Like, you really have to do that more on the buy side. And by the way, this last thing, this is a great thing about maximum pessimism trading. I'll just finish on the note on that. On it is that what's really interesting about doing that sort of trading is I worked it out and I looked at all the markets that had tanked since 2009. So Greece and the pig countries in Europe tanked in 2011, 2012. Russia fell hard in 2014. Commodities and gold and silver in 2015. And then obviously in 2020. So even during this, a lot of sectors did. 3D printers at the bottom in 2020 were off 95%. So even during this huge bull market of 2009 to 2021, every year or two, there was this great opportunity. And you didn't have to chase Amazon. You didn't have to chase Nvidia. You could have just bought these beaten up sectors, held them for a year or two, seen them go up 500 or 1,000%. And I wish I would have been smart enough to do it. I did it with a few stocks here and there, but not all the time. And this is where you learn from experience, right? This is why most good hedge fund managers start in their 40s, and I'm in my 40s now because they have to learn from their mistakes. But anyhow, you would have outperformed the S&P by a great deal if you would have bought in Greece in 2012 and held it for 2 years, or bought in Russia in 2014 and held it for 2 years, or bought gold and precious metal stocks in 2015. Or you're talking about Brazil. Another good Brazilian dividend play is Vale, which is the iron ore company.
Vale, yeah.
Yeah, Vale, yeah.
Base metal, yeah. Iron ore, base metals.
It went to $2 in 2016, and then it went to $20 in 2021. So if you would have held it for that 5 years, you would have made 10
dividends.
And you got a huge dividend. So that's really what you got to do. And that takes so much discipline. And you almost got to turn off CNBC. Don't listen to Jim Cramer every day. You got to just ignore stuff until you get those opportunities. And I guess to promote myself, I am restarting my newsletter. And this is the kind of trading philosophy I'll be doing in it.
And before we go, you wanted to talk about Sri Lanka. So there's literally blood on the streets in Sri Lanka. There's protests over high food prices. There's shortages of literally paper for schools. I think they ran out of paper 6 months ago. They didn't have paper for kids to go to school. There's a shortage of food. I think politicians at the Sri Lankan government are begging Western governments now for diesel fuel. So literally there's blood on the streets. And you were talking about potentially contrarian investing opportunities out of Sri Lanka.
Yeah, there's one second, let me get it right now. We were just talking about it. So there's this company in Sri Lanka, which is a holding company, and they have everything like hotels, all kinds of, and it's been around since Sri Lanka, like India is a former British colony, right? They've been around since about the 19th century. And I'm going to get it right now. John Keells, so Keells. It trades on the Colombo Exchange, which is the Sri Lankan exchange. It also trades, of all things, the Luxembourg Exchange. But if you have an Interactive Brokers account, I think Interactive Brokers does have access to Luxembourg, right? And they're just like a huge holding company, basically, of the Sri Lankan economy. And it's totally obviously collapsed because of everything happening there. So that might be something you might want to look at. Unfortunately, there's no ADRs because Sri Lanka is such a small company, small economy, no ADRs and no ETF of the market there. But that's something you might want to look at. And one thing that's pretty amazing is that the Colombo Exchange in Sri Lanka, despite everything that has happened there, has not stopped trading. The shorts have attacked it, and now there's blood in the streets. The valuations are down. So instead of the politicians like in Turkey or some of these other countries shutting down the stock exchange, instead they let the blood run in the streets and the valuations collapse. Yeah. So Yeah. So, although, by the way, I think Turkey's close to a good buy as well. But anyhow, I think we're not quite there yet, but it's getting close. But yeah, I think again that's something that you need a little more maneuvering. But I know a lot of people do own, do have accounts at Interactive Brokers. I'm pretty sure you'll be able to trade that. And then again, that's the kind of thing. Like I remember when Iceland collapsed in 2008. I was looking at Icelandic Air, right, which is their big airline in Iceland, and it traded on the Icelandic exchange, and it went down like 99%, and it went up like 1,000%, the next few years afterwards. So like,
I was interviewing you years ago, and when Greece collapsed, and no one wanted to touch Greece. I think Hillary Clinton's husband and MF Global guy, they blew up from buying Greek bonds. You were in there looking for quality assets to buy in Greece.
Yeah, and actually, one thing I really like, again, we keep going on and on here, there's so much to talk about, but I really like telecom companies because number one, because of their debt lows. People go, why do you like something with a debt low? Because that makes them a little leveraged when you have a debt crisis, so it crushes them on the way down, so they get really cheap. But on the number two, they'll be bailed out by the government because people need to use their cell phones and their telephones and all that sort of thing. And number three, they're in a kind of a recession-proof business. Like what's one thing people are probably going to hold on to, even in a place like Sri Lanka right now? I bet you everyone in Sri Lanka is still using their cell phone, right? So
in a lot of emerging markets, people are paying on their phones. So like that started in emerging markets, I would say, before it started even here in the United States and other Western countries. It skipped regular telephones in these emerging markets, in the regular landline telephones. They went directly to cell phones and mobile payments.
Yeah, like. One reason that like they didn't have all this copper infrastructure or telephone lines, like landline lines in Africa, is what you're talking about. In Africa, people just started using cell phones and started like using all their payments online on their cell phone, et cetera, right? So, but anyhow, to get back to the telecom companies. So HL Toy was the company I liked in Greece. That's Hellenic Telecom. And another thing too about telecom companies. The U.S. is so huge, having 350 million people and gigantic economy. You guys have whatever 6-7 major carriers. Well, most countries that are smaller, that have like 20 or 30 million people and smaller economies, tend to have, like here in the Bahamas, we have 2 carriers. Tend to have 1 or 2 carriers. So most of those, again, telecom companies, will.
So it basically gives you exposure to the entire economy with 1 or 2 companies.
Yeah, 1 or 2 companies are basically monopolies. They'd be probably bailed out, if there was a big downturn, that sort of thing. So, and because they're such big, they do generate a lot of cash flow. When the economy eventually recovers, they tend to pay out huge dividends as well.
Well, Dave, I've kept you over an hour. I want to thank you so much for your time. If my listeners want to follow you on Twitter, sign up for your email list so they get notified when your paid newsletter starts again, how do they do so?
Yeah, I'm just David Skarica, my name on Twitter, and addictedtoprofits.net is my website. And like I said, next week I will be starting probably, I think June 29th is the day I've got slated to launch the new pay letter. So and I'm going to have a bunch of deals. I would just sign up to the email list or write me an email at addictedtoprofits@hotmail.com, and I'll give you some more details as well. But I'll do a few. I'm going to do a new deal for like discount prices, etc., for the relaunch. So thanks for having me. We had a lot to talk about. So we haven't talked in a long time though. And off air, we were talking about football and all kinds of other crap.
It's good to take a mental break from investing with all the craziness going on. I mean, it's just bonkers, all the craziness that's happened the last couple of years, all the rules changes and bailouts. It's disgusting what these governments and central banks and large corporations and hedge funds now. Hedge funds are getting secret bailouts now. So all these large hedge funds like the Ray Dalios, the Bridgewaters, the ones who are putting on the risk parity trades, the ones who are claiming deflation and then front running the Fed and the ECB with the bond trades, and then the central banks are monetizing the debt and inflating the asset prices with the Cantillon effect.
Oh yeah, totally. Like so. Well, actually, the last thing I'd like to end on, just on that note, what I find amazing right now is, I do think at some point they'll reverse course when the markets go down enough, etc. And but everyone's talking about the Fed pivoting. I'm like, no, they've just started the tightening cycle. It's like, you saw Bill Ackman did did a thing on that saying that they should just raise rates all at once now and everything would tank and they can cut again. It's like everyone wants them to cut again so there can be another boom in the equity markets. And I'm like, no, like these rate hikes are just starting. Like they're way behind the curve. This is going to go on for at least another 6 to 12 months, So I think people need to get off that. And like, I think that's just like people wanting their, stock portfolios bailed out.
Well, a lot of people were long stocks, a lot of other risk on assets. A lot of people were not diversified. A lot of people didn't have a lot of cash waiting to buy opportunities. People kept buying the dips on Bitcoin, kept buying the dips on like a lot of these riskier technology stocks and NASDAQ 100, kept buying, betting on the Fed that they were going to lower interest rates. So people were long US Treasuries, betting on capital gains instead of buying US Treasuries for yield. So all of these types of trades, especially the ones that people had them on a lot of leverage, the dip buyers, those things are going to blow up. The leverage and the risk on stuff is going to wash away. Sentiment is going to it's going to take some time for sentiment to change.
I want to keep going. I don't want to keep going on forever, but when you think about the last 40 years in the market, even like the 02 and 08 crashes or 2020, every time you've bought like, a big bear market dip, even like a 30, 50% dip, you've always been rewarded. So I think coming out of this massive 40-year cycle for risk assets and stocks and bonds, and I think that's ending now, I can understand why people wouldn't really understand that. And then we have a lot of morons in the market we talked about that, NFTs and crypto that know nothing. So that kind of adds to that as well.
Yes, and all that waste and fraud and corruption and abuse, at some point it gets washed away, although I don't think the regulators are going to put really anyone in prison, but people will temporarily learn from their mistakes, and the leverage players that were over leveraged, they will get exposed. So thank you, Dave, so much for your time, and we'll have to have you back on again in the not too distant future to look at how some of your predictions have progressed.
Yeah, that's for sure. Thank you for having me. Thank you.